Hi, we're Group 20 and our members include Anton, Yacha, David, Judy, and Lo. So our group's product objective is to allocate $5 million into a range of investments and then use financial and investment principles that we have learned throughout the course. Our risk-free rate is 3%, so we have to achieve the returns above that rate. And then our assumption is that it is a stable macroeconomic environment. So we will use NPV, IRR, and expected return analysis to ensure that we can achieve a net positive value.
Right. With $5 million on our hands, it's an important question to ask about what to do with that money and how we allocate that across the different sectors. So, to answer that question, we will put $1.25 million into stocks and equities, $1.75 into bonds, $1 million into preferred shares, and roughly around, due to currency exchange rates, into real estate in Hong Kong.
So we invested a total of $1.25 into the stocks. You can see that we invested into 3 stocks, which are Vanguard, Johnson & Johnson, and the Coca-Cola. So it is a wide range of stocks, which include healthcare, F&B, and so on. And we assume a constant growth rate of dividend. Here, to calculate the growth rate of dividend, we use the first equation to calculate CAGR. And rather than assuming the rate of return arbitrarily, we use equation 2 and 3 to estimate it. And then, for calculating dividend and number of shares, these are the equations.
So, by discounting the future cash flows at each year's and each companies, we can, including all the projected dividends and the expected terminal values, we calculate the positive net values and for the portfolios, and this means the investments is expected to create a significant value for our initial capital. Furthermore, the portfolio's internal rates of returns of 6.83% exceeds our required rates of returns. So this confirms that the expected profitabilities compensates us appropriately for the risk taken. And in summary, the positive NPVs and attractive IRRs could demonstrate that this is a financially sound decisions and along with our goal to grow the values of companies' net asset value.
Moving on to bonds. As we know, it is a relatively safer investment, so we want to capitalize on that characteristic and make safer bets while still allowing for some returns. For that reason, we have chosen Apple corporate bond, US Treasury bonds, and Ford Motor bonds as in our portfolio. The first two are very highly rated at either AA+ or AAA, which means they're very safe. At the same time, just to keep the returns a bit higher, we have incorporated around a tiny bit of Ford Motor bonds, which pays 6% coupon rate. However, as you can see here, it is slightly lower rated. Next slide, please. After our calculations, the expected returns for the total bond portfolio is around 4.4%, which is, of course, higher than the 3% risk-free rate. Our portfolio will show around 30% in Ford Motor bonds, 30% in T-bills, and 40% in Apple. This ensures that it is a balanced portfolio that has decent return while maximizing our safety.
So for the preferred stock part, we have looked into 5 different preferred stocks, which are commonly traded in the stock markets. So they are from different industry, they have different yields, and they have different features, as you can see in the table here. So we also did some calculation in the Excel file. We did some calculation on the NPV and the IRR value, and we found that the Citigroup Capital 8 has the highest NPV with over 100,000 value, and the IRR for it is 7.7%, which is the highest among all preferred stocks. So to balance the risk, we decided to spend half of it in the Bank of America and the another half in the Citigroup Capital 8. So the full calculation and details will be shown in the final report.
For real estate, I've chosen Kings Hill and 38 Western Street, Saigon, mainly because it is 8 minutes away from HKU, and HKU has 42,000 students in Hong Kong U, and there's a lack of sufficient dorm for them. As for the financial commitment, we're investing around $7,675,000. So we're going to get 50% mortgage from the bank with an annual interest rate of 4%. As for our financial snapshot, we've already included costs for management fees, insurance, taxes, and a modest but realistic annual property appreciation of 4%. And in total, we're going to be getting around $4,937,000, and we're going to get a net profit of around $1.26 million. So this brings us to our KPI. Our net present value will be around $668,773, and our internal rate of return will be 6.8%, and our net rental yield will be 2.69%.
To sum up our portfolio, our investment promises diversified risk exposure while maintaining very strong returns. As you can see from the table, each one of our asset classes maintains positive NPV, which of course leads to positive cash growth. Our weighted IRR after our calculation comes to 5.92%. That, of course, is larger than the 3% risk-free rate offered in this scenario. After 3 years, our final future value comes down to around $6 million. Thank you for your time, and thank you for listening to our proposal.